Look at this number. $64.8 billion. It's not the budget of a war. It's not the valuation of a Silicon Valley unicorn. It's a ghost. Most thieves need a mask and a weapon to steal a few thousand. But to steal this much, you need something far more dangerous. You need a bespoke suit. You need a seat as the chairman of the NASDAQ. And you need the absolute, unquestioning trust of the smartest people on the planet. This is Bernie Madoff. For 40 years, he didn't just rob people. He convinced them to hand over their life savings while they thanked him for the privilege. When you look at the raw data, a terrifying question emerges. How does a man run a fraud for nearly half a century while the world's most elite regulators are sitting in the office right next door? This is my personal analysis of the largest Ponzi scheme in human history. It's not a story about a bad guy. It's a story about the lethal blindness of legitimacy. If you think you're too smart to be scammed, you're exactly the person Bernie was looking for. Bernie Madoff wasn't born into the Wall Street in crowd. He was born in Queens in 1938. His father, Ralph, was a plumber who tried to break into the financial world. It didn't go well. The SEC eventually forced his father's firm to close for unauthorized activity. Bernie watched the failure. He learned early that in this world, if you aren't the hunter, you're the prey. In 1960, he started his own firm with just $5,000. Where did that money come from? Lifeguarding at the beach and installing lawn sprinklers. He married his high school sweetheart, Ruth, and together they built Bernard L. Madoff Investment Securities. At the start, Bernie was a crumbs guy. He dealt in penny stocks, the messy, low-value trades that the big banks at the New York Stock Exchange wouldn't touch. But Bernie had a chip on his shoulder. He felt like an outsider. He later told investigators it was very obvious he wasn't part of the elite club. So, he decided to build his own club. He and his brother Peter became tech visionaries. Long before the world had heard of high-frequency trading, Bernie was pushing for electronic markets. He didn't just trade stocks, he changed the plumbing of the entire market. By the late 1980s, his legitimate business was processing half of the New York Stock Exchange's order flow. He was making $100 million a year. He became the chairman of the NASDAQ. Think about the mechanics of that. The man who would commit the largest fraud in history was the same man the government turned to for advice on how to keep the market honest. He wasn't just in the room. He owned the room. When did the fraud actually start? Bernie claimed it began in the early 90s. His COO, Frank DePascali, said it had been going on for as long as he could remember. According to FBI files, the scheme didn't start with a master plan to steal billions. It started with a cover-up. Bernie's father-in-law, a successful accountant, started referring clients to him. These were friends and family. Bernie made a bad trade. He lost a significant amount of capital. In that moment, Bernie had two choices. Admit the loss and damage his reputation, or lie. He chose to lie. He fabricated a series of fake trades to hide the loss. He thought he could extricate himself after a few weeks. He thought he could win the money back and fix the books. But he couldn't. One lie became 10. 10 became 1,000. To pay back the first group of investors, he needed money from a second group. The snowball was moving. And it was growing. By the early 90s, the investment advisory side of his business was an open secret among the in-the-know crowd. It wasn't supposed to exist. Bernie never registered it with the SEC. If he had, they might have audited his actual holdings. So he masked the fraud as part of his legitimate market-making work. Market observations suggest that people knew Bernie's returns were too perfect. But they didn't ask questions. Because Bernie was a pillar of the community. He was the man who could do no wrong. Is it possible to be too legitimate to be a criminal? Bernie proved that the answer is yes. The firm was a masterpiece of theater. If you visited Madoff Securities, you saw the future. High-speed computers, marble floors, and hundreds of legitimate employees. This was the shield. But the truth lived on the 17th floor. The 17th floor was a time capsule. It was filled with old PCs, dot matrix printers, and a handful of hand-picked employees. These workers weren't allowed to talk to the legit staff upstairs. Their entire job was to fabricate reality. I've analyzed the FBI reports on the computer boys, George Perez and Jerome O'Hara. They didn't use advanced algorithms. They used old copies of the Wall Street Journal. They would look at the stocks that had gone up the most over the last month. Then, they'd write custom code to print fake statements showing that Bernie had bought those stocks at exactly the right time. Think of it like a fixed-price buffet. Bernie told his investors that no matter how expensive the food got, or how much the restaurant struggled, their plate would always cost exactly $10. In the real market, prices move. They are volatile. On the 17th floor, the math was whatever Bernie told the printer it was. They weren't investing a dime. When a new investor sent Bernie $10 million, the money didn't go to the stock market. It went into a single 703 account at JP Morgan Chase. It just sat there. When an old investor wanted to withdraw their profits, Bernie just took a piece of the new guy's money and sent it over. It was a global game of musical chairs. As long as the music kept playing, and as long as new people kept bringing their own chairs, the fraud was invisible. Bernie's real talent wasn't mathematics. It was psychology. He understood affinity fraud better than anyone in history. He didn't beg for money. He didn't advertise. He made it hard to get in. He targeted specific communities, the Jewish elite in New York and Palm Beach. He went to the country clubs. He donated millions to their favorite charities. He became one of them. When people asked him to manage their capital, he'd often play hard to get. "I'm sorry, we're at capacity. Talk to me next year." In the world of the ultra-wealthy, nothing is more desirable than what you can't have. It became a status symbol. "I have money with Bernie" was the ultimate flex at a charity gala. He promised what we now call the 10% solution. Most scammers promise 100% returns to target the desperate. But Bernie was smarter. He promised a steady, boring 10 to 12% every single year. Rain or shine. Market data from that era shows the S&P 500 swinging wildly. But Bernie's chart was a straight line up at a 45-degree angle. People didn't find it suspicious. They found it comforting. He was the safe bet for their retirement. He scammed Holocaust survivors. He scammed the Elie Wiesel Foundation. He scammed retirees who had worked for 40 years as teachers and plumbers. He looked them in the eye and told them their future was safe. And they believed him because he was Bernie Madoff. But one man wasn't buying the story. Harry Markopolos. Harry was a quantitative analyst. He was a math geek who spent his days looking at probabilities. In 1999, his boss asked him to figure out how Bernie was getting those 12% returns so they could copy the strategy. Harry looked at the numbers for exactly 5 minutes and realized it was a physical impossibility. I've analyzed Harry's 2005 report to the SEC. It lists 29 red flags. The most damning one was the volume. Bernie claimed to use a strategy called split strike conversion. He said he bought 35 blue-chip stocks and hedged them with S&P 100 index options. Harry did the math. He found that for Bernie's trades to be real, he would have to be buying more options than actually existed on the entire Chicago Board Options Exchange. There weren't enough pieces on the board for Bernie to be playing the game he described. Harry also noted that Bernie's returns had a 0.06 correlation to the market. In layman's terms, the market didn't matter to Bernie. Whether the world was in a downturn or the economy was booming, Bernie made 1%. Harry sent his report to the SEC. It titled it, "The World's Largest Hedge Fund is a Fraud." And what did the regulators do? Nothing. They were starstruck. They interviewed Bernie, and he was charming. He made them feel like they were part of the inner circle. They didn't even bother to check the bank accounts at the depository trust company to see if the trades were actually happening. Harry spent 9 years screaming into the void while Bernie continued to take billions from unsuspecting families. Every Ponzi scheme has one mortal enemy, reality. In 2008, the world changed. The housing market underwent a systemic correction. Institutional liquidity began to dry up. Widespread market anxiety set in. Banks were merging. Firms were seeking government assistance. Suddenly, Bernie's clients didn't want their money to be safe. They needed it. They needed it to pay their own debts and cover their own losses. In December 2008, investors requested a total of $7 billion in redemptions. Bernie looked at the 703 account at JP Morgan Chase. He only had $300 million left. On December 3, Bernie pulled his COO Frank DePascali aside. He didn't use fancy words. He just said, "I'm out of money." The musical chairs had stopped. And there were 4,000 people standing up without a seat. On December 10, 2008, Bernie Madoff knew the game was over. He held the firm's annual Christmas party and handed out early bonuses. Then, he called his sons, Mark and Andrew, into his penthouse. He didn't offer a grand apology. He didn't show remorse. He simply told them the truth. It's all one big lie. The whole thing. It's a giant Ponzi scheme. He thought his sons would help him hide the remaining cash for a few more weeks. He was wrong. His sons were horrified. They walked out of the apartment, called their lawyers, and contacted the FBI. The next morning, special agents were at his door. They asked if there was an innocent explanation. Bernie looked at them and said, "There is no innocent explanation." Bernie Madoff was arrested on December 11, 2008. The shepherd was finally in a cage. The headlines focused on the $65 billion. But the data shows the real cost was human. This wasn't just rich people losing extra money. It was the life savings of people who had worked for 40 years. It was charities like the Elie Wiesel Foundation, a group for Holocaust survivors, losing $15 million. Overnight, thousands of people were penniless. Some victims found themselves owing money they had already spent. Why? Because the interest they had lived on for years was actually stolen cash from other investors. The court-appointed trustee began clawing back that money to give to others. The fallout was permanent. Several major investors met tragic, personal endings in the wake of the scandal. But the shadow fell heaviest on Bernie's own family. Bernie insisted he acted alone. He refused to testify against his staff. But the public and the legal system didn't believe him. On the second anniversary of Bernie's arrest, his son Mark, unable to handle the shame and the endless lawsuits, reached a tragic breaking point. Bernie hadn't just stolen capital. He had poisoned his own legacy. Bernie Madoff was sentenced to 150 years in federal prison. It was the maximum the law allowed. He didn't fight it. He didn't plead not guilty. In prison, Bernie became a strange kind of celebrity. Reports from fellow inmates suggest that even in a cell, the instincts remained. He reportedly cornered the market on hot chocolate in the commissary, buying up all the packets to sell them for a profit to other prisoners. He was a shark until the very end. He died in a prison medical facility in North Carolina in 2021, at the age of 82. No family members attended his funeral. His body was cremated. A quiet end for a man who made $65 billion of noise in the shadows. We like to think we're too smart to be scammed. We think Ponzi schemes are for the desperate or the uneducated. But Bernie Madoff proved that the opposite is true. He scammed the smartest institutions on the planet. He scammed the biggest banks in Europe. He scammed the regulators who were paid to watch him. He did it by exploiting a basic human mechanic, the desire to believe someone else has the secret. Historical data suggests that wherever trust is absolute, oversight is usually absent. Market observations show us that geniuses are often just people with better printers. Is there another Bernie in the market today? The evidence suggests that we shouldn't look for villains in masks. We should look at the people who tell us that their strategy is proprietary. We should look at the people who say we wouldn't understand how our own money is being made. We don't have to be experts to stay safe. We just have to stop believing in miracles. Because the next ghost won't look like a criminal. He'll look like your best friend. He'll look like a chairman. And that's exactly when you should start running.